Hello and welcome to another episode of India and Global Left. If you are new to the show, please smash that subscribe button. Also consider becoming a YouTube member, a Patreon, and donate small amount given in the link in the description box. But the least you could do is to watch this show, like, share, and comment. Without further ado, let me welcome our guest today, Steve Keen. Professor Keen is an Australian economist and author. His most famous books include Debunking Economics. Professor Keen is a distinguished research fellow at University College London and visiting professor at University of Amsterdam. Professor Keen, welcome to India and Global Left.
Good to join you.
I want to discuss economics with you, of course, and I
hmm
think two key events have captured all our imagination since the Trump administration came to power. Uh, eh,
Mm.
um, the first, of course, is the so-called tariff war or trade policy, which I think is a bit misleading because given the scale and nature of it, it's not just limited to trade. It has enormous implication on finance, on currency, on industrial policy,
hmm
on capital reallocation, and so on and so forth. So that's one pillar of it. And the second pillar is the new budget reconciliation law, which is effectively the US tax and spending policy, which just passed in the two houses. So before we get into the weeds of these policies, if you could give us your sense of what is the United States doing economically speaking, and what is its relationship to the rest of the world at this moment?
Oh, I think it's trying to pull itself out of a mistake of its own making, because if it wasn't for the United States delegation at Bretton Woods overruling the proposals put forward by Keynes, we would have a financial system where there is no national currency used for international trade. There'd be a specific unit of account used called the Bancor. That would not give any country privileges of seigniorage, which the United States currently supposedly enjoys. But that seigniorage means that because we use the American dollar for international trade, the dollar is overvalued, which benefits their financial sector but undermines their manufacturing sector. And after 60 or 70 years of that, we've gone from where America was the world's largest trade surplus nation to where it's, in terms of total dollars, the world's largest deficit nation. And as a percentage of GDP, it's running a deficit of the order of 4 to 6% of GDP every year. That is undermining the economic policy of the country, and that's led to the growth of the Rust Belt because there's so much relocation of production by American corporations taking advantage of lower effective wages overseas. Again, that's partly caused by the overvaluation of the American dollar, and that's created the Rust Belt, and the Rust Belt is why Trump got elected, because so many ex-working class would-be Democrat voters found themselves kicked out of the interest of the Democrats who pandered to the financial sector. And Trump basically used their frustration as a means to get into power. And now he's trying to reverse some of the consequences of that decision, but in the most chaotic of ways. I don't really need to say that, but it's obviously chaotic. So I think America made a mistake in 1944. We've paid for that mistake for the last 80 years. And now it's come home to roost in terms of an America that is uncompetitive with China, massive political dislocation domestically. And Trump is trying to both exploit that for his own benefit, but also just basically disturb the entire apple cart of economic relations. He's got a real estate magnate's approach to economic policy.
There is a lot there, and I'll come to many of these aspects, the currency, dollar, financialization. But in the context of the so-called big, beautiful bill, if we
Mm,
could start there, and if we could start even before getting into the breakup of where the cuts have been and where there are
mm,
increases and so on, if we could hear your thoughts on this larger question of what is a sustainable deficit. You mentioned about running 4 to 5% every year. There are Congress Budgetary Office's calculation that by 2035 it would lead to a total debt to GDP ratio of 118%. And of course, there is a mythology, the whole neoliberal, neoclassical mythology that government cannot sustain deficit. Talk about that, but also address the two concerns that are laid out generally. One is the inflation. Uh, in what way inflation actually poses a limit to unlimited deficit financing, and a second is its relationship with the bond market. To what extent, in a hyper financialized world, the bond markets would allow the state to run enormous deficit?
Well, we're confusing two words here. I talk about a trade deficit. You're talking about the government
Oh, okay,
deficit.
okay,
Yeah.
sorry,
So
yeah.
let's go to the government deficit first of all, because this is a classic category mistake, of instant reaction to the word debt, and then think, well, if I'm in debt, I have to earn money to repay the debt, and if I can't, I go bankrupt. And then applying exactly that same concept to the government without looking at the overall structure of the financial system. And this is one thing I've specialized in, building Ravel as a software package which lets you look at the actual structure of any financial system and see it all from all points of view and see, who owes money to whom, how is money created, et cetera, et cetera. Now, when you look at that properly, you see that the fiat money is created by the government running a deficit. In other words, if the government doesn't spend more than it takes back in taxation, then it doesn't create any fiat money. And we live in a mixed economy where there's both fiat created money created by the government and credit money created by the private banking system. And the obsession with the government deficit as if it is like a household spending more than it earns means that people are saying, oh, we shouldn't create any fiat money. So we should have no fiat money in a fiat money system. And this is what I find so frustrating, because when you look at the accounting, and again, Ravel is the only program that enables you to do that easily, if you didn't have the government running a deficit, then you just had a pure private sector economy. So you just had private banks and private non-banks who had to borrow money, of course, from the private banks. Then in that situation, the private non-bank system would be in negative net worth, negative financial equity, because banks, the way that private banks operate, they must have positive equity. A private bank must have more short-term realisable assets than it has short-term realisable liabilities. That's just a rule of banking. It's applied by a state, so partially I'm leaving out this little detail that the state has to approve a bank and before a group of individuals can form a bank. But even if we had like a totally private market system where you floated yourself on a stock exchange to become a bank, you would have to have short-term assets far greater than your short-term liabilities for anybody to take you seriously. And then if you get to the point as a bank where your liabilities, short-term liabilities, exceed your short-term assets, then all it takes is somebody saying, oh, look, that bank's got more liabilities than assets to have a bank run, and the system collapses. And we saw that with Silicon Bank recently. So in that case, back to the basics of my argument, if you had a pure private banking system with no fiat money creation, the non-bank sector would have to be in negative financial equity, because one person's financial asset is another person's financial liability. So if one person does their sums and finds their assets are greater than their liabilities, so they're in positive equity, then the rest of the world is in identical negative equity with respect to that individual to exactly the same magnitude. So if banks are required to be in positive equity, the non-bank economy in a pure credit system would be in negative financial equity. And nobody likes this. This is one of the great dilemmas. Something nobody likes, but somebody has to have that role of being in negative financial equity. So the response of the private sector when that happens, and we've got 200 years of data to look at on this front, is almost always to borrow more money from the private banks and then buy what are best described as non-financial assets. And a non-financial asset is something which is an asset to you and a liability to no one. So that's therefore always going to be a positive sum for non-financial assets. The things like fundamentally the main two categories are shares in excess of the limited liability of the company and houses, property, real estate. So even if you have a mortgage on the house itself is the asset of the person who owns it and the liability of no one. So we borrow money from banks to gamble on the monetary price of non-financial assets. You buy a home, and people say, "Don't worry, it's cost more than you can afford, but don't worry, the price will increase and you can sell it for a profit." Well, there's actually a positive feedback then between the rate of growth of private debt and the level of asset prices, and that's empirically overwhelming. And that therefore means that what drives the price of non-financial assets is increase in the amount of money people are borrowing to create them. So you get an amplifying feedback that leads to a crash because it can't be sustained indefinitely because at some point someone there's the easiest way that a bubble like that falls over is people are borrowing money to buy houses. House prices are increasing, so you've got to take out more debt to buy the house the next time when it's next sold. In the meantime, the person who's servicing that debt can't manage to pay the full debt. They fold and the whole system collapses. So we saw that in 1929 with shares. We saw it in 2007 with house prices. So a
So
pure credit system.
it is often internal what you were saying. It's not
Yeah,
necessarily external as neoclassical economists would say.
it's an internal dynamic, and you can see it in the historical record again. When the government tries to reduce its debt level, what that does is it drives the non-bank financial sector into negative financial equity. And so the response in that situation is to borrow money and gamble on asset prices. You get a bubble, which then crashes. And the biggest bubble of all was 1929. If you take a look at the borrowing that people did back then to buy non-financial assets, the main ones they were buying were shares. They'd buy shares on margin debt, and margin debt lets you put down $100,000 and buy $1 million worth of shares with a $900,000 loan from your very friendly broker. Well, that level of debt went from 1% of GDP at the beginning of the 1920s to 9% of GDP when the crash occurred. And then when the crash occurred, it wiped out people in one day because if you had margin debt and you had a 10% fall in the value of shares, your equity was destroyed. So you were then required to put in more money, which you couldn't do. You'd have to liquidate other things that happened in one day in 1929. And then you finally saw the stock market crash by about 88%, I think it was the total fall from the peak to the trough. So these things are unstable. They're bad news, and they're a product of the fact that the non-financial private sector finds itself in negative equity. Well, if you have a government spending more than it gets back in taxation, it's going to negative financial equity, but it can back that with all the power of the state. The non-financial assets of the states are the army, the navy, the air force, the police, the education system, and on you go. So the non-financial assets backing what the states does is enormous, as well as its authority. So it can handle being a negative financial equity, which means it enables people to have more claims in it than it has in other people. And then that negative financial equity for the government creates positive financial equity, not just for the banking sector, which must have it, but also for the non-bank private sector. And that means there's less desire, less pressure to go and gamble on asset prices, and you get a saner version of capitalism. So there's a very good reason to have a government running a deficit, spending more than it gets back in taxation, because that creates a form of money which is debt-free for the private sector. And the so-called debt for the government when you look at the accounting, it is not debt as you and I mean it, because if it was debt as you and I experience, then you could sell your debts to your wife and therefore eliminate your debt. Now, if we can't do that, but the government can effectively sell bonds to the central bank and consequently ends up with no debt servicing costs on its debt. Now, so all this stuff means that if you look at the accounting structure of the financial system properly, a government deficit is not a problem, it's a feature of a well-functioning capitalist economy. And this obsession that Trump had temporarily, but Musk has it permanently, with eliminating the deficit is just a complete category error and will actually drive us back to the instability and craziness of the 19th century if he gets his way. I don't think he will, but that's the sort of madness that's going on in America right now.
If there is a positive correlation between the government deficit and the non-financial, or let's say the non-bank financial sector, and there is also definitely a positive correlation between the deficit and the people at large. I mean, the multiplier effect and so on and so forth. And there is no negative correlation between the deficit and the banking sector. Then who is driving this superstition that the government has to create a
It's
surplus
it's
budget? Is
it's
it
basically
those
sorry.
bond holders who get nervous beyond the point? Because ultimately bond holders also like the deficit because they can earn easy money out of that without
They
any
can buy
risk.
bonds,
Of
yeah,
course.
yeah,
Then
and the
who
money
is
they buy.
driving this? Who is driving
I
this
think
crazy thing?
it's just neoclassical economists. It's the dominant school of economic thought, which is ignorant of the basis of money, and they get taken seriously because people outside economics think, oh, economists, they must be experts on money. Okay. And then we listen to their, oh, they tell us to not run a deficit. Oh, that must be good advice. They know what they're talking about. They are as good about giving advice about money as Ptolemaic astronomers would about be giving Musk advice on how to get to Mars. Okay? They've got a completely inappropriate model, but that's become part of their religion fundamentally, and people don't easily give up their religion. So what we're getting is a priesthood that believes that money doesn't matter initially, but also believes that the government should not run a deficit because it'll go bankrupt. And you look at the accounting, I can put their model into my Ravel software and I get the result. Oh, yes, there's going to be a catastrophe. There's only one trouble. Their model's false because they assume that the government borrows from households, what they call the model of loanable funds. And if it was true that governments borrowed from households, then yes, there'd be a crisis. Okay? But in fact, governments, when they sell bonds, they sell them in the first instance to private banks. And the revenue that the banks use to buy those bonds is actually created by the deficit itself. Because to spend more money on you than government taxes on you, it has to put a net positive sum in your deposit account, and the balancing item on the asset side of the banking sector is an increase in reserves. And then when you take a look at the central bank, that increase in reserves came out of a fall in the treasuries account at the central bank. And take that back to the treasury, that fall was created by the government effectively deciding to create negative equity for itself, to create claims on itself. And that's what fiat means. You know, I decree. The meaning of fiat is effectively I decree. I decree that this project is going to take place. I decree the money into existence that is going to fund it. And then that money becomes wages and profits for people in the private sector. So it's a major part of demand for the private sector. Now, all this stuff is completely scrambled by a theory of economics that trivializes money, which is what the mainstream does. So and what it means is people go through that stuff, they learn enough of this to take it seriously. What they end up being, though, is like a bunch of non-professional amateurs who accepted the argument of the professional astronomers that the Earth is the centre of the universe and all the moon and stars and planets orbit around us on perfect crystalline spheres, and we then take them seriously. And if we continued taking those people seriously, we would never have got off the bloody planet in the first place. So in that sense, I see my analogy really goes back to Copernicus and Galileo trying to convince astronomers at the time that the Earth was not, in fact, the centre of the universe, but being treated as fools and idiots because, hey, they can't explain why if you throw something up in the air, why does it fall back down if the Earth's not the centre of the universe, etc., etc. So the standard of neoclassical dialogue on this is literally as stupid as the defences against Copernicus made by Ptolemaic astronomers at his time. So there's no benefit. Nobody's really benefiting out of this nonsense. And one I'd like to illustrate that is all the, you say the bondholders say, oh, the government's going to be bankrupt. Okay. Well, if I was central bank governor, tomorrow I could buy all outstanding bonds, every last one. Okay.
And
All I've got to do is
that has
yeah,
been done by the Fed in the crunch moments like 2008, 2020, COVID moment.
and just open market operations all the time. They're doing them all the time as well. So because the central bank is a bank that all the banks bank at, so therefore they've got bank accounts at the central bank like you and I have at a private bank. then the government can easily, I mean, because they're not taking out a loan in this case. You and I, to get money from a bank, we've got to apply for a loan. The bank has to agree to create the loan before we get the money. With the government, it bundles up bonds, it creates new bonds that are equivalent to the excess of spending over, say, over taxation in the current time period, plus interest on already existing bonds. Well, it simply says we're going to offer those bonds for sale. Now, because the deficit itself, the excess of spending over taxation, has created money in the private the bank accounts of the private sector, people like you and me and corporations and so on. The balancing item for that is an increase in reserves. And if we go back to before the global financial crisis, which of course the mainstream had no idea was going to happen, at that stage they paid no interest on reserves, but banks kept reserves at trivial levels anyway because they were an asset which they couldn't trade and they didn't make any interest out of them. Okay? So in that situation, when you have the reserves being created by spending exceeding taxation, that creates a non-income earning, non-tradable asset for the banks. Now then the government says, we will sell you bonds equivalent to the increase in the reserves, and we will pay interest on those bonds. Would you like to buy some? Well, the sensible answer is yes, please. Okay. Now, so the best way to illustrate how crazy this would be, as I said, would be for the central bank to say, okay, you're complaining about too many bonds, we're going to buy them all, we're going to put 50 trillion in your bank accounts, and then you'll give us $50 trillion worth of bonds, and you'll do it because the face value of the bonds is actually 45 trillion. We're feeling generous, we'll give you 50 trillion for them. No bank on the planet would turn that deal down. So suddenly all government debt would be owned by the government, it would disappear. Now, the first people to scream after they went off and had the party over the 5 trillion profit they made from selling the bonds for a profit to the central bank, they'd scream, "Where's our interest income?" Well, you told us not to create any. Oh, but we need it. Well, what do you want us to do? Well, run a deficit, please. That's the sort of thing which would happen. And I've had it. I mean, I'm so sick of amateur analysis of this, mainly coming out of people with PhDs in economics.
So if not for the negative equity of the government, the banks would have been forced to hold massive levels of cash reserve ratio because the statutory liquidity reserves are the bonds that they hold, which are higher, where they get higher income. If not those things, either they hold a lot of piles of cash without any income, or they just don't hold it, which increases massive amount of risk and instability, and under which the banks would anyway collapse.
Well, they'd have to issue more loans. They want to make money. There needs to be an increase in the level of lending, and the banks are quite willing to do that during things like, for example, the increase in the oil price in the late 70s, early 80s, when the oil price went from $10 a barrel to 40, and all the Texan oil producers thought, whoopee-doo, we can make a fortune out of this. So they all approached banks for loans to put down new drills and so on, and during drilling rigs. And there's a huge increase in the financial value of Texas, and then the price crashed from 40 to 10 again. So all those loans went bad. Now, this continuous cycle of booms and busts has been a feature of capitalism for its history, and it comes out of banks lending for speculative ventures like that, some of which succeed and some of which are a necessary part of the improvement in technological capability in capitalism over time. But it's a boom and bust cycle, and the government spending eliminates the negative, the downturn, not completely, but it removes the likelihood of a complete collapse. And that's one reason why I'm going to be doing another video on that front shortly, that if you don't have a government money creation, then you are more likely to have extreme bubbles and crashes. And the best way to get out of it is for the government to create negative financial equity for itself, which creates identical positive financial equity for the remainder of society. And that means we can behave in the relaxed fashion that used to occur in the 1950s and 60s America, which was, it's still talked about as the golden age of capitalism. One reason it was private debt was much lower, and people weren't being forced by just looking at their financial situation and seeing that they're in negative equity to go and gamble on shares and house prices all the time. So it was possible to buy a house for a working class income in America. Now it's not. But all this comes down to the not understanding that the government should run a deficit. It's not a case of a bad idea. It's a necessary part of creating a balanced credit fiat system. And we had that back in the 50s and 60s. We've lost it. And everything that Musk and Trump are talking about now would only make that worse.
And I think it's not just about banks. I mean, banks are very, very important, but it's also non-bank private sector. I mean, I'm thinking about high net worth individuals holding
Mm,
part of their investments in bonds while they aggressively invest in stocks, but even including derivatives. I mean, one of the things
mm,
recently we were seeing in India is the regulators cracking down on the derivative market because too many retail investors without any experience are participating in the derivative market because you don't know need a lot of capital to buy derivatives,
mm,
and there is a lot of leveraging out there as well. And what I'm saying is, without the government money, people would go more crazy on the
mm.
riskier side of investment, from stocks at the one end to derivatives at the other end. And now with technology making a lot of changes in the, I think, creating further instability. One of the things SEBI, the regulatory body of the stock market in India, reported is that one of the reasons why instability is increasing within the retail sector is the use of the mobile apps. So
Yeah.
people are now at one click are able to buy a derivative instrument, and YouTube buffoons and all kinds of social media
Mm,
things are encouraging them to bet against large institutional players who can use massive algorithm to buy shares in microseconds, and they are losing money. I mean, report says that 97% people have lost money within the derivative market. So at least the bond market provides a lot of stability, not just to the banking sector, but also retail investors, isn't it?
yeah, yeah. And that's a essential part of the role of the government is that provision of money without debt for the person who gets the money, and that gives you a form of financial security. So you didn't feel compelled in the 50s and 60s when you had much lower salaries, of course, but much lower asset prices. You didn't feel compelled to have to borrow money to go and gamble so you could afford to pay your house. You
Right.
were paying your house out of your wage. So when the government runs a sufficiently large deficit, when it spends more than it takes back in taxation. And so my usual figure that if you're actually in full employment, then you'd want the government deficit to be equal to the rate of growth of the economy divided by the velocity of circulation of money. That's the rough growing rule that maintains the ratio of government money to the overall monetary system and to the economy. So that's rather than zero. In other words, your target should be a positive one if you're living in an economy which is growing over time. And then what I expect us to fall into, which is a collapse caused by global warming, in that situation, the private sector is going to collapse for sure. Private banking system. So in that situation, the only money you could use would be government created money. And governments being stupid about that, which is again what neoclassicals are encouraging them to do, is setting up for us up for another giant fall. So yeah, we just have to normalize, rather than having zero as the reference point for what the government gap between spending and taxation could be. We have to say it's got to be positive, so that you create sufficient credit money to maintain the balance between credit and fiat money.
You said something very interesting, that this desperation to take more risk, especially for small retail investors. I'm not talking about the major financial institutes.
Mm,
People like, even including college going graduates, and people who have just had a job which doesn't
yeah.
provide you even a living wage. The necessity to take more risk increases when you don't have a living wage, and that has to do a lot with the welfare schemes that government runs, which has to do with the negative equity that we are talking about. So in the context of the so-called big beautiful bill, we are seeing
Mm,
massive cuts in healthcare programs, in food assistance, the SNAP as it is called in the United States, and the clean energy projects. So my question is uh, bankrupting the social welfare schemes also a means to force people to rely, at least the middle class, more and more on the asset price sector of the economy? And that is sort of leading us to more and more into the financialization of our economy.
Yeah, I think it's definitely been a factor in the increased financialization of the economy. And like it's crazy because it means people who are pensioners are spending all the time wondering whether their portfolio is big enough to enable them to continue living in their house before they die. And parents who should be trying to raise children are often calculating they won't have kids because they can't afford kids and a house at the same time. So all this stuff has become incredibly destructive of the normal functioning of a capitalist economy, because you want people to be able to earn to get not to earn an income, but to get an income stream when they can no longer work or when they're too young to work. You want to have an educated workforce. You want everybody benefits from an educated workforce. We all suffer from an uneducated one. And we're seeing that with the political situation globally right now. So all these things are undermining a well-functioning system. And it is painful to watch it happen because what it will mean is the people who think they're going to benefit out of this will actually, they might benefit for a while, but they'll end up in a system where people are happy to rob you because that's the only way they can get the food to survive. So it's destructive of the nature of a society, and I just see no end to it until we start seeing that destruction happening, and then in the consequences, you can now see why it was a mistake. But to get to the stage where you actually have to find out the hard way, this is what theory is supposed to prevent. Theory is supposed to give you a way of analysing what's going to happen before you do something. When the neoclassical theory is so wrong about the nature of capitalism, it leads people to doing something completely wrong, thinking they're doing the right thing, and then they get shocked with the outcomes.
To just get back to my question about whether there are limits to government printing, and you addressed the question
Mm,
about the bond vigilantes and why they don't matter as much because the
mm.
central bank can buy them up. What about inflation? What is the limit that inflation poses insofar as expanding money is concerned?
Well, funny, let's actually take a step further back again, because since credit is far more volatile than government spending, it tends to be credit that causes expansion and contractions in the money supply more than government spending does. So what you see is past periods of rapid increases in the money supply are actually credit driven more than they are government money driven. There are exceptions like COVID, which was huge. So government spending was about 20% of GDP, in excess of taxation, that is. And then in the Second World War, you had government spending being 40% of GDP at the peak of the war for America and UK. And what that meant was if you didn't take that money out of circulation or focus it specifically on armaments and the military and so on, then you would have consumer price inflation. So if you look at what happened in World War One, there was of course an unexpected global conflict, which led to governments creating large amounts of money to finance their militaries, and then you had huge inflation in World War One as well. Now that lesson was learnt by American bureaucrats and to some extent British. And so when the Second World War was approaching, they said we can't allow this to have huge amounts of inflation like it did in World War One. So they set up price control systems. They set up rationing, so you didn't have to have money to be able to buy food. You could use your ration card. But they also sold bonds to the private sector. And even Charlie Chaplin, and no, Charlie was quite an extremely intelligent man, but you wouldn't imagine an entertainer to understand why he's being entertaining. And he specifically said that he knew he was being asked to sell the bonds to the American public so that there'd be more money going to the military and less going into consumption. Now, the impact of that was that money creation in the Second World War was by the government was twice as large as it was in World War One, and the inflation rate was half what it was in World War One. So it shows there's a certain amount of management that give you control over inflation in that sense. But the ultimate limit, and that's why is that if you continuously have a government creating more money than is equivalent to the rate of economic growth divided by the velocity of circulation, then you are going to be making more monetary headroom for things like firms to put up prices by increasing markups, or workers to find full employment, meaning they can campaign for a higher money wage. Those sorts of things give you inflation. But when you look at the causation, and I've got a colleague of mine doing some very good work on this right now, you find that the sequence is not that money growth causes inflation, but inflation causes money growth. And the logic here is fairly simple. If you have, most people have a credit card. Okay? With a credit card, if you have like $10,000 as your unused credit card limit, you can go and buy something worth $10,000 immediately. The bank can't stop you. They've agreed that you can have that amount of money. That creates the money. So there's an increase in price for something. That can mean that companies access the equivalent of their credit cards, and when they've got to pay more for something like oil or labour, they simply access that extra money creation capability they've got in their loan agreements with banks. So the inflation change in prices leads to a growth in the money supply. So what you need is to realise, and this is a lot of the work of Isabella Weber, who's a fellow similar logic to me in economics, and Isabella's argued that what you need to control inflation, pardon me, are agreements between workers and capitalists and government, are basically to accept the current distribution of income, because it's when there's disputes over the distribution of income that you get demands for higher wages, markups being increased by firms. That's what gives you inflation. So partially, yes, the excess level of government money creation can enable that to happen, but it's not so much the cause. The cause is those social conflicts being unresolved and fought out in battles over markups and wage rises.
But it is often considered the government arm is often considered the most flexible arm to adjust inflation, because the private credit creation, it's very hard to pull it back if, let's say, in the event of an inflation. I mean, that would create further recession. So it is said that in the event of an inflation, ultimately it's the government arm that the central
Yeah.
bank can raise the interest rate. So okay.
Yeah, and what you get out of that when you take a look at the data, and there's some great American data. I can actually show it if would it be at all beneficial. Is it useful to share screen or okay? So if you
Wait,
enable me to share this,
yes, yes.
just send a request there, and then I'll load the relevant file if I can just. I've got to quickly find it on my system, but I want to show the inflation rate um, before and after World War too, because so many people think the government's caused inflation. Before we had government, we had stable prices, and then inflation has been caused by the government. So if we get rid of the government, we'll get rid of inflation. Won't that be great? Um, Now there's a database maintained by the American Fed, the Minneapolis Fed. I'm just going to quickly take a look at. I'll just get rid of. I'm just changing a bit of my graphic here. So I'm just going to set it up so we see the whole period from 1800 to 2024. And let's see. Okay. So now I'll share my screen. Okay. So you look at that and it looks obvious. Ever since World War II, which starts about here, we've had rising prices. They've risen very rapidly since 1970, 73 on, really bad, rising prices. Obviously, the government causes inflation. And look back here, how stable prices were back at that stage. Okay, well, what you can do with my Ravel software, which is very neat, is I can say, well, let's just take a look at the period before World War II. And you don't see stable prices anymore, do you? You see prices being massively inflationary and then massively deflationary. Another inflation bout, another deflation. Now, all these deflations are associated with economic collapses. If you take a look at um, both the CPI and I'll just put this on that particular graph so I can see that more clearly. So if you then take a look at the entire time period now and look at inflation as well as the CPI, what you see is we actually had higher inflation in the 18th century than we had in the 19th century than we had in the 20th. But what we didn't have since World War II is deflation. So what the government has eliminated is not, it hasn't created inflation where there was none beforehand. It's eliminated deflation when there was both deflation and inflation beforehand. And when you look at these periods of massively declining prices, they go in hand with massive financial crises. And there was a major financial crisis in the 19th century, virtually every 10 years. So rather than being stable and yada, 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 and wouldn't it be nice to get back to it? One reason we created large government was to avoid that sort of chaos. So again, it's the lack of historical context that leads to a lot of these stupid ideas by economists.
So clearly, if anything, larger government fiscal activism has stabilized crash at price levels, avoiding basically the deflationary cycles, while allowing inflationary cycles to happen, which happens because of the private credit sector.
But even so, one of the amusing things about that chart is I showed you the inflection point was 1973. Okay. Well, that was a huge credit-based boom. There's a boom globally, but I particularly saw it in Sydney. There was a huge commercial real estate boom, and I was at university at the time. I could literally see the commercial skyline of Sydney from my university campus, and there were just cranes everywhere, building into a huge bubble. Workers had incredible levels of employment. The unemployment rate in Australia was literally below 1.5%. And that's before they started distorting the numbers to make them look artificial. It was literally less than 1.5% of the population who wanted a job was out of a job. So anybody who wasn't employed was basically between jobs. It wasn't a case of chronic unemployment at all. And that led to huge wage rises. So you had a combination of huge wage rises plus the OPEC price increase, where after the Yom Kippur War, the OPEC states put an embargo on any country which had supported Israel during the war. Of course, that included America. So you had a quadrupling of the oil price as well. Now, that set in train the remaining dynamic of inflation, competition between workers and oil producers over shares of the profits, and firms fighting back with higher markups and so on. But that's all been the sort of conflictual stage of the post-war period, which I again would blame neoclassical economists for letting it happen. Because if we'd realised that you can actually get price stability if workers and capitalists agree about the distribution of income, and then what you're left with is actually a likelihood of deflation, because as we've improved our capacity to exploit energy and we've improved our technology over time, so long as you don't run into energy bottlenecks, the general trend is for falling costs of production, because we're getting, using technology to harness energy more efficiently, and we're increasing living standards in general by increasing the amount of energy we all consume. There are complex feedbacks in the energy system with that, but nonetheless, what it means is most people in the 50s and 60s weren't unhappy about the distribution of income. Now, because of the massive inflation of property prices and the fact that your wages have fallen, all that tension is there, and the tension has been created by this dysfunctional model of the economy that neoclassical economists believe is the real world.
And would you agree that to some extent China today resembles what you are saying? Because, I mean, apparently there is a Faustian bargain of wage moderation and, profit moderation, if you like, although there have been massive rise of billionaires overall because of its massive expansion. But we haven't seen inflation at all. If at all, the problem is deflationary in China.
Yeah, and that's again because there's much more of a history of collective thinking in China than the West, of course, and that's not just communist. It's right back to the days of the feudal system, and the fact one of Marx's good points was that he talked about the Asiatic mode of production, and what he focused on there was the fact that in particular in China you had to have massive public works to enable the irrigation to take place. So there was an extent to which individuals knew they were required to do collective work as well, and then the collective work would benefit their farm because they help create an irrigation system which ends up irrigating their crops. So the extent to which people have a collective attitude as well as a competitive attitude is something which I think China's politics and China's history give it more of an understanding of than the Americans, who are just rank ignorant on this garbage, on this stuff, frankly. So yeah, China can say, well, let's, workers won't demand wage rises so long as wages rise every year. And now, if you look at what China's achieved over the last 40 years, it's simply breathtaking. I was there in 81, 82, and I saw how primitive life was back then. But since then, on average, the increase in per capita income has been 9% a year. Now, that means that less than every decade, people are seeing their incomes doubling. And you don't feel the need to demand a wage rise when you're getting one already effectively at that level. And what it means is often you don't get the same nominal wage rise, but your prices are actually falling, courtesy of that increase in output per worker.
Absolutely. I think one of the misleading truths, if you like, being told by the Western business press to its Western audience is this unqualified category of cheap Chinese labor. And of course, there is an element of truth in it, in to the
There is,
extent
yeah.
that compared to the larger pool of investment, the percentage that goes into wage is relatively smaller than what it is in a, let's say, credit-fueled economy like the United States. But
Mm,
when you look at the annual wage trajectory, it has risen massively. I mean, has far outweighed, Taiwan, Mexico, of
mm,
course, India, and literally virtually any other country. If you look at Chinese wage growth since 1990s, that's over and above large segments of occupational transfer of people from agriculture into industries and now into the service
mm.
sector. So most people in China have lived a better life since the 1990s, and that's like ridiculous to flatten that as this unqualified category of cheap labor,
Yeah. I
and
mean, that's what they started that way. I mean, one of my formative experiences was taking a group of journalists for a tour of China in 81, 82. And we went to the Shenzhen Free Trade Zone, which is the first free trade zone China established. And they told us that they were targeting American companies which wanted to use a loophole in the American law to export some material from America to a third world country, get rework done on it, and by this loophole, not pay any tariffs on re-importing it back into America. But the deal that they insisted upon, and I still makes me shake my head to understand why American capitalists agreed to this. To actually establish themselves in the free trade zone, they had to have a Chinese partner, and within 5 years, the Chinese partner had to own half the business. Now, for American capitalists to agree to that, the advantage they must have been getting in cutting their wage costs is so huge, they're willing to give up half their profits to get hold of it. So that initial stage was definitely driven by low wages. But when you know the Communist Party membership and what people are like, they're primarily engineers, a major emphasis there was getting American technology as fast as possible, which they did, and then taking it apart and improving upon it, which they've done. So the overall gain, it started with low wages, but it's now enabled them to transition to a highly skilled workforce with commensurately high wages. And they're now doing things America couldn't even imagine doing. The classic, I think you would have seen it when Tim Cook was being interviewed about China in China. He said if he had a meeting of all the machine tools experts in America, he could hold it in the auditorium he was speaking in. But if he wanted to do one for all the machine tools experts in China, he'd need several football stadiums. And that gap in terms of skills is now what's driving the gap between American and Chinese productivity. And people are foolish if they think it's just low wages, anything but.
I guess a related question to this would be, what is the pathway for industrialization for the Western capitalist economies? I mean, particularly one is should think about the financialized economies like the UK and the United States.
Mm,
But one can also think about the more industrialized parts like Germany and others, given there are now so many constraints. I mean, China and others coming up as rivals, eating up into its traditional sectors like automaking and chemicals and so on and so forth, but also climate change imposing limit on production, automation. So a lot of populist policies of President Trump and other right wing or left wing populists in the West is about bringing back jobs home, but they know that there is a huge cost disadvantage, which all corporations massively resist. And so, even if automakers go back to the United States, it would probably be more robots than workers. What is your vision about what should be the level of industrialization in these very advanced late capitalist economies, and what should be their policies?
Well, I mean, they've got to reverse everything. They've got to reverse neoliberalism, which they've been doing for 40 years. And it's been destructive of their supremacy. It hasn't enhanced it, it's undermined it. But my main feeling now comes back to climate change because, again, economists, particularly William Nordhaus, I can name the guilty parties on this side, have fooled themselves and then fooled politicians regarding climate change as no big deal. Uh, and in fact, it's far more dangerous and far more immediate than economists have realised. So at some stage, we're going to see a collapse in food availability. And the only countries that are going to survive that are those which have sufficient capacity to produce their own food and it wasn't just and don't it doesn't get destroyed during droughts or floods, etc., etc. So my feeling is we've got to go right back to basics. We've drastically overshot what we can actually support on the biosphere in using fossil fuels and the damage we're doing with carbon dioxide, but also what we're doing to biodiversity and uh, you know the amount of topsoil is back to the agriculture again. So many things we've undermined. Uh, I think it now is no longer a case of growth; it's a case of survival. And to survive, you must be able to produce enough food for your population. If you don't do that, then your system's going to break down, no matter what it is. So my focus is really on saying food sustainability is first and foremost. And that should be the objective of every country to increase their capacity to produce food and to have stocks of food waiting for the day when it's going to happen, when there's a global famine. So I could answer the question on what to do, but I don't think it's relevant. I think the main thing now is, again, courtesy of economists, we've pushed economic growth far too far, and we're now going to be going to economic collapse or unwinding. And if you're going to hang on to a society in that situation, you must be able to feed your people. So what I can tell, China's working in that direction. I saw, I haven't researched it, but I saw a YouTube piece about China uh, moving ocean water and desalinating in the process to an area of desert, relative desert in the west of the country, which, if they manage to revive it, will double the arable land of China. And therefore, when any crises hit, it can feed its own people. Uh, the UK is in no situation to do that, for example. So if there is a global famine, then one of the first countries to suffer will be the UK because food prices will spike and possibly countries will stop exporting food. You might know that India 2 years ago, I think, banned the export of rice and now only exports basmati. That's going to, when we have a global food famine, when there's a collapse in food production of, particularly grain crops, when that hits, then any country that doesn't produce its grain is going to be in deep trouble, and that includes the UK to an outstanding degree. So my whole focus now isn't on industrial development, it's food security.
And I think the smaller nations, and particularly those in the temperate regions, would be even more vulnerable given their inability to produce a range of foods. And I think the buffer that you spoke of, it's been worked out by many economists, including Isabella Weber and Jyoti Ghosh in India, who argue that building buffers in food stocks would not just provide more stability during the times of crisis and downturns, but it also ensures a more stable income for farmers, because one of the problems we are seeing, particularly in the global south, but also in the developed parts, is that the commodity food prices have been extremely unstable. There are gluts and the prices crashes, and then there are demand crashing, and prices go up, and it's important to stabilize. And what they are saying is that the states leading that process of buffer creation can also, by procuring and redistributing out in the market, can stabilize income for farmers. Um, we are almost end of time. I had so many more questions to ask, but we'll leave it for the next time. But if we could ask you one more question before you go. You begin with the dollar being allowed to become an international currency as a big problem, and there seems to be a confusion, or let's say a dual goal within the Trump administration. At one hand, to preserve the hegemony of dollar. So, he wants the dollar exchange rate to remain high, because to that remains tied the fortune of the Wall Street. On the other hand, given his vision of bringing back job backs home, he also wants to devalue the
Mm.
currency. And I think, like, my own reading is part of all these meme coins and Trump coins and all are also might be part of that, which is to like force the sovereign wealth funds in Japan and the central banks to give up a lot of holdings of its treasury, but buying up these coins so that the yield doesn't rise on one hand, but the dollar at the same time devalues. I'm not saying that that would be effective, but I think that's a strategy at a very theoretical level. So you push up these prices of these coins, you keep yield down, but you also devalue dollar so that you can industrialize. What's your thoughts on where the dollar is heading towards?
Well, that's quite a feasible, but I think that Trump's doing that more because he makes money out of it, not because he
Of course.
wants to stabilize the economy. I mean, you're seeing he's selling cologne now, 47 and 49 cologne. And any opportunity for a sale, and he's selling his brand, he'll be into it. But yeah, the the great dilemma is if you reduce the value of the dollar, then you reduce the wealth of people measured in dollars. But if they've bought assets which rise faster than the dollar, then they can look like they come out ahead. So it probably is part of what they're thinking. I wouldn't glorify it by calling it a strategy, but that's likely to be part of the thought process that they're caught up in. But I mean, it's just Keynes once wrote that when the investment when the development of an economy is a byproduct of the activities of a casino, the job is likely to be all done. Well, we're seeing that on steroids now.
Uh, can you stay back for one more minute?
Yeah, sure. Yeah.
Okay, I want to throw a game at you, and that will be interesting. I'll name some economists, and you should just tell me one sentence or a word. Like, don't say anything else, and we'll see what the response of our audience is, and we can do a like full show on that.
Okay.
Minsky.
The only person who ever asked the right question in economics, which was, can it happen again? It being a Great Depression. And if we'd based our economics on him, we wouldn't have had the 1987 bubble or the 2007 crash.
Keynes.
Brilliant. Unfortunately, too much of a child of Marshall, so trying to fit many things back into Marshall's mind again, but understanding the fundamental nature of the uncertainty that people investing have to deal with, and not being willing to make nonsense assumptions about uncertainty to eliminate it. So the philosophical foundation for a decent economics, unfortunately undermined by believers in the old paradigm like John Hicks.
Adam Smith.
The person who led economics astray. If you look at what he did, he said labour is the source of all value rather than land, which was the arguments of the physicocrats beforehand. That ended up making economics non-physical. A lot of the belief that wealth comes out of the economy, not from exploiting nature, you can track back to Smith. He also supported the idea that money was bullion rather than money being credit. So I think Smith was I actually tag the origin of most of the problems of economics back to Smith.
Karl Marx.
Brilliant, absolutely brilliant, but unable to break away from his own ideology. So he developed an explanation for where profit came from that neither Smith nor Ricardo had, and that focused on the exclusive unique concepts, characteristics of labour. Then he developed a philosophical advance on that in the 1850s, which undermined the labour theory of value. But to hang on to the conclusion that he was the scientific socialist, he distorted that thought and led to the labour theory of value still being believed by Marxists and making them an irrelevance to the development of economics over time.
Last second, Milton Friedman.
Uh, he got one thing right. He was in favour of abolishing private banks and having the Chicago plan. But apart from that, an ideologue whose ideas were fanciful, and his basic proposition was make a crazy assumption, get people to fall for it, and then the results follow from the crazy assumption. Schumpeter called that the Ricardian vice, and Milton Friedman was probably the most dangerous exponent of it in history.
My final one, and it's more contemporary, Thomas Piketty.
Piketty's good empirically. I like what he's done about focusing on the growth of wealth and so on. He hasn't broken away sufficiently from neoclassical thinking overall, but he's focused upon wealth in a way that neoclassicals have ignored, done some very useful work on that front, and I hope to see him move in the more heterodox direction over time.
Professor Keen, thank you so much for your time. And viewers, if you like this final segment, do comment. We'd have a full show on covering economic thought. Thank you so much.
And I'll just throw in my own little promotions there. Look for
Yes,
my
please.
own YouTube channel. So Prof. Steve Keen, please sign up and subscribe there. And if you want to really help me out, then subscribe to my Substack or my Patreon pages, which are fairly easy to find.
Thank you so much, Professor Keen. Have a nice rest of
You're
the day
welcome.
ahead. Bye.
Okay, bye.
Hi, my name is Ayushman. I, along with Jyotisman, have started this platform. In the last 2 years, we have tried to build content for the left and progressive forces. We have interviewed economists, historians, political commentators, and activists so far. If you have liked our content so far and want us to build an archive for the left, I have 2 requests for you. Please do consider donating for the cause. Link is in the description below. Also, if you are not able to do so, don't feel sad. You can always like our videos and share our videos to your comrades. Finally, don't forget to hit the subscribe button.